Welcome to Traders Terminal. In this video, we will share 5 essentials for successful trading. Watch this video till the very end and I can tell you with utmost genuineness that at the end of it, you will be in a better position to increase your trading efficiency. Alright, so let's get started. Number 1. Stock market terminology. Yes, understanding stock market language will enable you to understand the market dynamics better. What I mean by this is, if you do not know the numbers between 0 to 9, will you be able to do any basic mathematical additions or subtraction? No. Similarly, if you do not understand the terms used in stock trading, you will not be able to use them to your advantage. So now, in order to help you overcome this challenge, we have shared this link where you can easily search on Google Financial Term Dictionary by Investopedia or Dictionary Investopedia. Financial Term Dictionary on Investopedia website is your one-stop solution for all the financial terms you do not understand or do not know. You can easily post your query here. Let's take trailing stop loss for example. As you can see, it shows you all its search results and you can pick the one which suits your query the best. So spending time daily in learning just one definition will not take more than 5 to 10 minutes, but down the line it will definitely improve your trading. Number 2. Margin and order type. Basically, margin is just an initial token payment paid to your brokerage house in order to facilitate trading. This is because brokerage houses are just mediators and not liable for any loss or profits that occurs in your account. Therefore, to secure themselves, they ask for a token payment used as a collateral against any particular loss you may incur in that particular trade. So margins in cash market segment comprise of the following 3 types: value at risk margin, extreme loss margin, and mark to market margin. The most important of the 3 is value at risk margin. Value at risk, as the name suggests, is basically potential loss one can make in that particular trade, or in simple terms, value at risk answers the question, how much is the stock likely to move over the next one day? So now, how does value at risk component determine different order margins? Order types which have predefined margin risk or predefined value at risk will give you more intraday leverage than naked orders. We'll take example of Zerodha as it is one of the most commonly preferred brokerage house. So let's take an example of Adani Ports. Zerodha allows you to take a margin of 5x on your intraday orders in naked cash. But now, what if your value at risk is predefined? So first, how can you predefine your risk? You can predefine your risk by placing a stop loss at the time of placing a buy order. So that is what cover orders and bracket orders are. So basically, bracket orders and cover orders are order types which have predefined value at risk component in deciding the margin. Hence, in this particular order type, you will get higher leverage than compared to normal MIS naked order. As you can see from this window that MIS margin in equity segment is 50% of VAR, that is value at risk. But when you predefine your risk by placing a stop loss, then the value at risk component is just 30%. Therefore, you get an additional 20% leverage. This is the reason why bracket orders and cover orders in Zerodha gives you more leverage than normal MIS orders. Number 3. Beta, the volatility indicator. The beta factor describes the movement in a stock in relation to that of the market. So by definition, the Nifty 50 index has a beta of 1 and individual stocks are ranked according to how much they deviate from Nifty 50. So let's understand how the beta factor affects your intraday trading. Alright, so this is a list of Nifty 50 stocks with betas using Nifty 50 as base. So here the Nifty 50 index will have a beta value of 1 and the stocks will be assigned a value in correlation to that of Nifty. So let's understand with practical examples of first 3. Number 1 is Adani Ports. Adani Ports, as we can see, has a beta value of 1 in daily 1 month range. What this means is that Adani Ports has moved in exact correlation to the Nifty movement. So if Nifty has moved 1% in last 1 month, Then Adani Ports has also moved up to 1% in the same period. Number 2 are Asian Paints. Asian Paint is a low beta stock. What it means is that if the broader index, that is Nifty, has moved 1%, then Asian Paints has moved 0.57% in that set time frame. And let's take number 3, Axis Bank. As we know that banks have been volatile of late and beta accurately points that out. So if Nifty has moved 1% in last 1 month, Axis Bank in that particular month has moved 1.84 percentage. So this is almost double the movement that we find in Nifty. So a beta value can help you select stocks for intraday. Now, beta also affects your value at risk. What do we mean by that? It means that the value at risk margin in this particular stock can be greater than the value at risk in this particular stock, and hence margin will be decided accordingly. So we can understand this by recent developments that have happened in the Indian stock markets. So what happens in this case, if Nifty is very volatile, brokerage houses block intraday margins. This is because the value at risk is very high for that particular day, and it is advisable to not provide leverage, and hence it is better for them to not provide any intraday leverage, which may result in huge defaults in case of losses. Number 4. Creating intraday watchlist. Creating intraday watchlist is a crucial step to cut off the noise in the markets. What I mean is that NSE has over thousands of scripts listed on its exchange. But it is important for you to create a basket of stocks which you can pick from in order to trade. And also, if you have a set of predefined stocks for a particular trading day, you are better positioned to find a good trade as it improves your focus and allows you to avoid FOMO. FOMO is fear of missing out. To help you create a watch list, we've added a couple of videos in this intraday course which you can check by pressing the I button or by pressing the link given in the description below. Also subscribe to our YouTube channel if you want to get daily intraday watch list created by us. Number 5. Trading discipline. Discipline is the most crucial element in stock market trading. Do you know that stop loss was just an instrument to inflict trading discipline in order to limit the loss in case the trade goes wrong? Majority of traders make huge losses in stock markets or stock trading not because of lack of knowledge, but because of lack of discipline. Therefore, discipline in stock trading is 100 times more important than technical indicators, technical analysis, any sorts of other analysis that you might do. Alright, with this we conclude our weekend trading lesson. If you're a trader, you can follow us on Telegram. Link is shared in the description below. Also, do not forget to subscribe to our YouTube channel and press the bell icon for regular updates. Happy trading!